and welcome. Good afternoon. You're watching Closing Trades on ET Now with me, Snehisha, and with me is Cheryl D'Souza. Let's take a look at what the market is shaping up to be like, and we seem to be around that 23,850 levels, just slightly under that right now. Not managing to hold on to those levels. Initially, in the first half of the day, we were above 23,900 and hoping to cross that 24,000 today. Not seeming very likely, but we still have 1 hour to go, so we can only be optimistic about the Nifty going ahead. 0.4% uptick coming in on the Sensex as well. Nifty Bank also holding up pretty decently in today's trade. 0.2% uptick coming on that front as well. It's the India Wix that is one to talk about. A 7% cut coming in on India Wix today, just above that 13 level. So it's looking very good on that front as well. Broader markets, however, not doing much in today's trading session. You have the Nifty cap that's managed to tilt over to the green, but not much happening. It's rather flat, but however the small cap index seems to be doing well and in line with the benchmarks. 0.3% uptick coming in on the small cap index as well. A couple of sectors that are making the buzz today. It's been a one-way gaining day coming in for autos today, once again on the front of the leaders, and 1.5% uptick coming in on auto, followed by pharma, media, FMCG, bank. You have IT and realty that surprisingly managed to tilt over to the green. Energy also holding on to the green by the skin of its teeth. What's not doing well today is Nifty Metal. That continues to be the top loser for the trading day, followed by Nifty PSU Banks. A 0.5% cut coming in on the PSU Banks as well. This is largely what the market is shaping up to be like. 1 hour of trade left. Let's see if we're able to at least breach the 23,850 level, if not 23,900.
Absolutely. So that's the way how the markets are faring at this point in time. Like Shrishti, so I beg your pardon, Snehi did mention that auto index is one of the top sectoral gainers in trade today. A solid recovery that is underway for all of these counters, because you have a brokerage note coming in from DAM Capital, which actually mentioned the fact that they're expecting to see a recovery in the auto space in FY26. There's comfortable valuation and favorable risk reward, and that's one of the reasons why they have gone ahead and upgraded Tata Motors to a buy rating with the target of around 870. Scott's Kubota is the other one where they have also upgraded the stock to a buy, and your Bajaj Auto as well, where they're seeing an uptick of about, they expect a target of about 9,750 rupees per share. Apart from that, you have Cochin Shipyard that is also in focus in today's trading session. You have Adani Ports order win, which is about India's largest order for about 450 crore rupees. So that's one of the reasons why you have Cochin Shipyard that's seeing a sharp uptick of as much of 5% as we speak. Apart from that, take a look at Viatech Vabag. They have bagged an order in Zambia. This is for wastewater treatment plant worth about 700 crore rupees is the order, and the stock is seeing an uptick of about 4%. Add to the list, IndusInd Bank, that one has also seen a very sharp move on an intraday basis. 4% is the up move that it logged on an intraday basis, because the bank has said that they've invited bids to sell non-performing retail microfinance loans worth about 1,573 crore rupees. So on back of that, you have all of these select names that are in focus in today's trading session. But we also have our guests joining in for the show. We have Dhananjay Sinha, who is the co-head of equities at Systematics Group, as well as we have Kunal Bothra and Naresh Mirani to talk about the markets when you talk about the charts. And Kunal, coming to you, it is the last Friday of the year 2024. Look at the way how the markets have been panning out. They've done absolutely nothing in the month of December. Nothing to give us a hope that we will likely even see any sort of a Santa rally in the last few trading sessions of the year.
Yeah, so I think sort of a disappointment as such when you look at this last 1 month. But then I think compared to the kind of correction we'd seen in the month of September, October, I think we would still be happy to have a muted kind of a reaction from the indices. I think we're down just 1.2% odd for the Nifty, for the month, and I think just about 1.5% for the Bank Nifty. But I believe that today's day and even yesterday, I think has been specifically earmarked for many of the sectors which have managed to give a bounce back. So you've seen the auto index, for second consecutive days, many of the stocks are seeing a follow-through up move. That's a very good sign for the sector overall. You've seen the pharma stocks doing pretty well, and many of these pharma stocks are coming out of their individual breakout zones. There are a few mid-cap names, which are seeing volume accumulation. So that's also another positive sign for individual stocks. So I believe that largely, I think we expected the index to remain to a range 23,750, 800 broadly as a pivot range for the index, and that's where the Nifty is just about skirting around.
Okay, levels to watch out for in the near term for the Nifty. But Dhananjay, coming to you, good afternoon and thanks so much for joining us on Closing Trades. Give us a sense of what you are making of the markets heading into next day, especially sectors like IT and pharma. IT not done very well for itself, but pharma and real estate are two sectors that have outperformed the entire street. Do you believe that the rally that both of these indices have seen will continue heading into the next year as well?
So I think from a market standpoint, the market has been fairly choppy in the recent months. I think the key factors has been the fact that earnings season hasn't panned out that great over the last couple of quarters. There has been a sort of a contraction in the profitability of non-finance companies, and I think that is impacting the earnings expectations from a consensus standpoint. So the consensus expectation generally starts with a 16% growth, and I would say that in the last uh, couple of quarters, it's averaged about 4%. So there is a downgradation that's been happening. Number two, with respect to the valuations, the risk-free rate, the benign view that market had actually taken is actually challenged with the Fed talking about only two cuts next year. And that is also impacting how we see liquidity domestically of what RBI does and the currency, etc. So these uncertainties are there, which is actually translating into some pairing of the valuations. So what we are seeing now is a sort of a easing of that pressure. Typically that happens after a major correction or a phase of correction. What we are seeing today is exactly that. And we are seeing that the concerns has actually eased with the VIX index coming down, both globally and India. So there can be an uptick in the market sentiment in the near term. So I think this market appears to be a rotational market. A lot of trading is happening. I would say fundamentally that the way we look at next year is that in the near term there will be pressure on margins that will continue with the rising raw material cost that is there. So a lot of companies, especially the consumer companies and other companies, might actually see that pressure. We are seeing pressure with respect to metals and cement and infra spending, etc., etc. So all those things are there. I would say that earnings might still undergo correction as we go forward. But I would say that the market would actually favor those segments that can actually see a sort of a consistent earnings outlook, etc. So it's going to be fairly selective in terms of how markets will pan out. I would say that what we are more positive on is the auto space. You mentioned some of it. Basically, we are more inclined towards the rural-oriented sectors, especially agri equipments, tractors is something that we're liking. We also have two-wheelers, for instance, Hero Motors and TVS are there. So we are kind of selective. We are not so positive on commercial vehicles and passenger vehicles because we think that there is a sort of a erosion of value of the premiumization story. So that is something we are sort of betting on. In the pharma space, I think we are overweight there as well. There are some stocks which are likely to show up good results in terms of their outlook and in terms of their product pipeline, etc. So we like the pharma space, and I would say in the current scenario, there has been a considerable amount of correction that has happened in the
Right.
consumer space as well. So we'll be looking at some of them, and I think e-commerce space is another place where that we like.
Right. So basically, there are a lot of sectors to watch out for, given the fact that even if we are talking about the year 2025 actually starting on a volatile footing, but looks like there are a lot of sectors that one can watch out for. But I'll talk to you more about that in a short while, Kunal. Actually, not Kunal, Nuresh. Let me come to you and talk about the way how the construct has been when you talk about the broader markets. How are the charts looking for the broader markets in particular? Because you saw a maximum shift coming in from large caps to small caps and mid caps, and then you also saw that shift back into the large cap space.
So overall, in the whole recovery, if you look at it, say the Nifty has barely moved up, say at current level, say from 23,200 lows to 23,800. it's barely a 3% move. But if you look at a small cap, Nifty small cap 100 or something like that, wherein you've moved up from say 17,300, 400 up to 18,800. So it's almost like a 6-8% recovery or even more in some cases of small cap indices. So clearly, the small caps have done better from the bottoms of November. And even in the recent correction, it's almost similar to what has happened with the Nifty or lesser than Nifty. And Nifty did not make a new all-time high, but small cap index did make a new all-time high. So the relative outperformance is there. For the last 1 week, we've seen a consolidation for the small cap index. We've not seen a recovery. Same is the case with Nifty. So for now, last 3 weeks, we've been in a band. So one day there is a 500, 600 pointer move on the Nifty, and then we stay in that band. That band right now is 23,500 to 24,000. Once we sustain beyond this band, we get a 500 pointer move.
Okay, so those are the levels to watch out for on the broader markets as well. Thanks, Naresh, for that. Let's once again shift focus and fondly remember the life and the legacy left behind by Dr. Manmohan Singh. And as we bid farewell to the visionary leader, we honor his unparalleled legacy and hold close his contributions to our hearts. Here is a special report.
The day was 24th of July 1991. It was a day that changed the course of India's growth story. One that made every Indian dream big. And a large part of the credit goes to this man, a Congress veteran, Dr. Manmohan Singh. And on this day, the then Finance Minister presented his first ever budget, one that would be remembered for decades to come. The government by then was already going through testing times. Facing increasing oil prices and a fall in remittances from Indian workers owing to the Gulf War, the Indian state was on the verge of a sovereign default. At $6 billion, India had just enough forex reserves to support 2 weeks of imports. Harsh decisions had to be taken. The government, under the leadership of P.V. Narasimha Rao, then decided to devalue the Indian rupee and pledge gold holdings as immediate measure to shore up forex reserves. But it was a new industrial policy unveiled on the eve of the budget under the patronage of Manmohan Singh that proved to be the game changer. The policy relaxed provisions in Monopolies and Restrictive Trade Practices Act to facilitate easier entry and restructuring of businesses. The policy ended the public sector monopoly in many sectors. It also announced a policy for automatic approval of FDI up to 51%, as against the existing cap of 40% for foreign equity investments. These dramatic changes ended public sector monopoly in several sectors, except in those that were deemed critical to national security. These changes not only led to a steep upturn in the foreign goods entering Indian markets, but also a dramatic rise in foreign investment in the years to come. But the reforms didn't end there. Manmohan Singh took it further with multiple drastic changes to stall what seemed to be a crisis spiraling out of control for the country in 1991. Faced with a fiscal deficit, the budget increased corporate tax rates to 45%. The government also opened mutual funds to the private sector and relaxed investment norms for non-residents. These measures were followed by the introduction of a second trade policy package to boost exports and a package for developing small firms. Seeking immediate economic relief, he also applied for an emergency loan of $220 million to the IMF, which later proved to be critical in preventing a debt default for the nation. As the Finance Minister, Dr. Manmohan Singh took drastic measures which not only rescued the nation but also propelled India into rapid economic growth. As the nation mourns the loss of one of India's greatest minds, the country will forever remain indebted to the astute economist who changed the course of India's growth story.
Welcome back. You're watching Closing Trades right here on ET now. About a little over half an hour left for the trading session to come to an end. And if you look at the markets, right now we've given up from those elevated levels, the advanced decline ratio neck to neck at this point in time. And you see a pretty good churn. When you talk about the list of gainers in trade today, you have Dr. Reddy's, that is the top gainer at this point in time, 2.9% uptick for that one. M&M, IndusInd Bank, Aisha Motors, Tata Motors, all of them holding on to good gains. While on the flip side, Hindalco is the top loser, coming in with cuts of about 1.7%. SBI, ONGC, Tata Steel are the other set of losers. Dhananjay, let me come to you then and let me talk to you about the entire commodity basket, stocks that are linked to the global commodity price, be it from the oil and gas space, be it the metal space. How are you viewing all of these sectors, and do you think that they are a bet to play or to take for the longer term, given the fact that these stocks are also dependent on what happens globally when these commodity prices move?
Absolutely. So we are kind of conservative on the space, and I think this space offers trading opportunities from time to time. But I think structurally, it is exposed to headwinds, especially in the context of what is happening globally. First thing is that you have a very strong dollar scenario that is panning out with whatever is happening in the US. The rate cuts have actually been reduced. So four out of 2 out of 4 that was expected for next year. So that's number one. And you have other currencies also sort of euro in particular actually weakening for the fundamental reasons that are there. So I would say a strong dollar is not a very positive thing for a metal space. So that's number one. Number two, we are seeing the impact of trade conflicts that could accentuate going forward with a Trump 2 regime taking more stricter actions against or tariff actions against China. And also I think that uncertainty with respect to the outlook for Chinese economy and the demand for that might actually be on the weaker side. And we know that China has been sort of dumping various products across the world, and more so for metals, because they are roughly about producing roughly about 55% of 50 to 55% of all the metal production that is there. They're also a consumer, but I think in a context where there is trade protectionism and there is a slowdown in China, the pressure on Indian companies with respect to the prices would continue. So I think if you look at the HRC, for instance, HR steel prices roughly trading about 25% lesser than Chinese products are actually trading 25% lower than Indian steel. So I think the pressure on the Indian steel makers will continue, and as a result of that, we are seeing that companies are asking for import protectionism against Chinese dumping, and some companies are talking about rolling back investment plans, etc. So I think if you look at the entire basket, it does look like there are a lot of uncertainty. So I would say that I would stay away from the sector, given the context that some of these headwinds could be structural in nature. I think if you the way to play this is to really look at auto space, where you have a resilience in volume and there can be expansion in margins because of that. So as I said, agri equipment, especially tractors and all, can benefit in that context. So I mean, we look at a sort of a pair trade where you look at sort of being low on the metal space, and sort of compensate that by higher weightage for some of these consuming companies such as auto.
Okay, thanks Anandra for that view coming in. Kunal, give us a chart check on some of these shipping stocks that have been a buzz. Cochin Shipyard, of course, we have news flow, so that's locked upper circuit of 5%. What's making Garden Reach go higher by 9.5%, 10%? And do you believe that this kind of exuberance that both of these stocks are seeing just today on an intraday basis can continue going ahead? What are the charts looking like for a couple of these shipping names, the likes of Cochin, GE Shipping? You have SCI on one hand, Garden Reach. Give us a broad check on what the charts of these companies are looking like.
So I'm bullish on the entire space. My belief is that the year 2024 has played out into two parts for many of these shipping stocks. there was a point where start of 2024, these stocks were just about continuing from their last 2 years of major uptrend as well as a rally. And mid of 2024, somewhere I think the month of July or August thereabouts, is where these stocks topped out. There was a point where these stocks corrected by 20-30% initially, and then what followed was an inertia selling where these stocks consistently drifted lower. Some of them, for example, Garden Reach, etc., managed to drift back lower towards their 200 moving averages. Some of them had managed to break below their long-term moving averages. So which means that we've gone through a classical point of a significant upside for these stocks in the first half of this year. In the latter half was where these stocks went through a price correction as well as a mean retracement. Now these stocks are poised at an extremely attractive risk reward, because we are looking at a juncture where these stocks have gone through a dull kind of a zone on the back of the corrective phases. Volume activity is starting to rise for these stocks. These stocks are not closer to their lifetime high levels, but they are just about some 10% to 15% higher from their previous swing lows. So I think in that aspect, I would believe that these stocks look fairly attractive. I also believe that there could be a point where, say in 2025, these stocks may get into a gradual kind of a rise. And I've assessed the charts for these names on a historical basis, that what happens when these stocks correct by a margin of 20-30%. It's not a V-shaped rally or a recovery which happens into these names. There is an initial period where these stocks slowly and gradually gain pace, volumes pick up for these stocks, and then once these stocks come very close to their lifetime high levels, that's where the momentum accelerates and you see these stocks showing extremely strong price activity. So I think we are still in that zone 1 where these stocks are gradually trying to move up higher, and that's why I think buying these stocks at current levels could be very attractive.
All right, so that's a take coming in on some of these shipbuilders, shipbuilding companies. On that note, thank you so much, Dhananjay, for joining us on the show and sharing your views on the various sectors that one can watch out for. And before we actually slip into a break, let me take closing trade picks coming in from you, Naresh, as well as Kunal. Naresh, go first.
So that would be about Sun Pharma. The stock has given a short-term range breakout in the last couple of sessions. And has been showing a lot of related strength. So expecting this to break out and slowly go towards 1900, 1950 would keep a stop loss below 1850 now.
Okay, Sun Pharma looking good to Naresh. Kunal, what about you? What's your closing trade for the day?
So I'll go with the buy on Laurus Labs. That's a chart which is looking attractive, very close towards breaking the previous major highs of 600 thereabouts. So expecting the stock to climb up to that 600 plus levels and then move on to that 630, 650 mark.
All right, so those are the closing trade picks coming in from our experts then. But it's time for us to slip into a break on this edition of Closing Trades. But before that, Adani Port has placed India's largest order for 8 state-of-the-art harbour tugs worth about 450 crore rupees. The tugs, to be built by Cochin Shipyard, will enhance the maritime infrastructure and boost local manufacturing. The delivery is expected to begin in December 2026 and be completed by May 2028. This move aligns with the government's Atmanirbhar Bharat initiative promoting self-reliance in the maritime sector. Adani's total fleet will increase to about 152, significantly improving vessel operation efficiency and safety in Indian ports.
Hi there, welcome back to Closing Trades. You're watching ET Now. Thanks so much for staying tuned with us. Let's take a look at what the Nifty is doing. Less than half an hour to go for today's trading session to get over, and we're comfortably, not comfortably, but we're barely above that 23,800 mark. We're slipping further away from 23,900, and Charles, I was being optimistic of seeing that 24,000 mark today, ending the week on a good note and, cheering on for the weekend, but that clearly seems like it's not going to happen today. We can still continue to hope for Monday. Nonetheless, Sensex also 0.3% up, and India VIX spiked slightly, but not much to worry about on that front. That being said, let's also talk about some stocks that are in focus in today's trading session. Kunal, a couple of railway stocks have been in focus today. Ercon has been doing well, and there is of course news flow on that one, but after this little bit of a slump that we've seen in railway stocks, what do you have to make of this, given that the budget is very close, and also do you have the same view on railways that you have on these ship stocks?
Yeah, very similar view for railway stocks. So I think except for IRCTC, which is something which I still believe is more of a stagnant stock, stuck into a range around the 800-850 mark as a pivot. I think most of the other stocks, they've already gone through a very sharp correction. Now, Ircon, for example, a stock which was almost at 350 levels mid of 2024 had come down to sub 200 levels. So a correction of more than 50%, 40% for these stocks in the span of the last 6 odd months. And now these stocks are now trying to make a comeback again. So Ircon has come back above the 200 levels. So when you see such kind of a price action where there is an initial major correction for these names, these stocks fall below the long-term moving averages. There is a divergence at play, and then slowly, steadily, we see zones where volumes start to pick up, into these stocks, and the prices start to settle back into a trading range rather than going for a major correction. That generally is a signal that these stocks are closer to forming a bottom for themselves. So I believe that the risk reward is attractive for many of these railway names. I think railway budget could also be another factor where these stocks, they generally pick up pace as well as momentum. So I'm expecting that hopefully in the second half of the calendar month of January, you might probably expect many of these stocks to come back to at least their long-term moving averages, if not break past above them.
All right, let me just mark a stock for you, that is Coal India. If you look at that counter, I think it's seen a dip over the last few minutes or so. There you go. I think it is at the day's lowest point, 1.6% downtick coming for Coal India. You have news coming on via agencies which is quoting it to Coal India official that they may miss the production target for FY25 by about 3 to 3.5%. What they're expecting is the coal output to be at around 810 millimetric tons versus 838 is what they had targeted. So on back of that news flow, you're actually seeing the stock correct sharply over the last 15 minutes or so. What they are citing is that the poor demand and high stocks at the mines, that's impacting the output. So that's Coal India for you. That's down about 1.6% at this point in time. And Naresh, let me get a quick chart check from you for Coal India. How is this one looking on the charts?
So it's broken a lot of supports, say for the last 6 to 12 months. The June lows are around 410. The lows of March are around 410. We tried to see a recovery in the month of November, but not sustain. We broke below 410. And now that a breakdown is done, the next major supports don't really come back, say till the time till 360, 350 levels. So for now, would be a buy closer to 350, 360 levels or on the reversal above 410.
Okay, those are the levels to watch out for when it comes to Coal India. Kunal, let's talk about a couple of big losers in today's trade. The likes of KFintech, Blue Dart, Amber, all of these stocks are losing away anywhere between 4.5% and 5%. What are these stocks looking like on the charts?
They're still looking attractive. In fact, for example, KFintech, Amber, these were the names which I think over the last 4 or 5 days had consistent price volume up move. And again, I think if I'm not wrong, these stocks had climbed up somewhere around 20%, 25% in just the span of the last 1 week or 7-8 trading sessions. So after such kind of a steep price uptrend, today's recovery, the markets would probably expect that maybe these stocks are just about getting a breather. And when you generally see volume activity into these stocks, and these stocks participating in the tough parts of the markets where when the markets go into a corrective phases, and that's where these stocks, they tend to be a lot more resilient. And when the markets see some sort of a relief rally, these stocks, they find those spaces to consolidate or just about get into a mean reversion. So I believe that we are into that latter phase for many of these names. Would be bullish on Amber as well as KFintech, and especially I think if this correction extends for another couple of percentage points for these names or for the next couple of days, that should be a good buying opportunity.
Right. Nilesh, let me ask you about Paytm, because this one actually a lot of them had written off this particular counter in the month of January and February when you had the RBI directive come in. From there on, the stock has actually worked pretty hard. It has actually surpassed the 1,000 rupees per share levels. What next target can one watch out for Paytm actually, because the rally over the last 3 to 6 months has been pretty swift?
So technically, the previous high was around 1,000 odd levels back in October of last year. We are seeing a pause around that area. We're seeing some volatility. A new range has been formed between 950 to 1,050. If it sustains above 1,050, we get into a fresh breakout mode and go towards that 1,300 mark, which is where the stock had actually made the low post listing. So for now, still the trend is positive, and 1,050 is a price point to watch out for. If it sustains above those levels, we get into a fresh leg.
To watch out for Paytm 1050 and then wait and watch going ahead. But Anand Tandon, who's an independent analyst, is joining us on the show. Anand, hi, thanks so much for joining us on the show. When I take a look at the December move coming in for the FMCG index, not done anything at all, down about 2.5%. And you have one of the biggest losers on the month-to-date basis. Also, Godrej Consumer is down 14.5%. Give us a sense of what you're making of the entire FMCG space. Do you believe that this recent correction that the space has seen makes it attractive, or do you think that the problems that they are flagging off in terms of urban demand slowing down or input cost inflation still persisting around, do you think you should still wait and watch further, or now would be a good time to make a fresh entry into the stocks?
Well, if you're looking at it from a portfolio perspective, FMCG has to have some space in it. You cannot be exiting it completely. More importantly, the construct that you have going forward is that you are expecting to see rural demand pick up. And that is where most of these companies like the Hindustan Levers, Davos of the world actually have the best positioning, because that is where they get much of their market from. More importantly, that is where they get most of their growth from. And also that is the one place where the competition from this quick service and so on, which will tend to reduce margins for these companies, is probably a little lower. So if the basic construct of the market is that we are expecting to see a growth in the consumption, especially in rural India, coming back in on the back of better monsoons, etc., then I think this may be a good time to start looking at that sector. It doesn't mean it will do anything dramatic, but the fact is that the market is so overpriced that it is not likely to do anything dramatic as a whole. So you may still get some outperformance from here going forward.
Right. Good afternoon, Mr. Tandon. Cheryl also joining in the conversation. Just I wanted to understand your take now when it comes to these investments in the new age tech counters, because we've seen a lot of them actually participate in a rally. They saw a dip, then you saw a comeback of all of these counters. How should one take a look at this entire space in the year 2025?
Well, these are difficult markets to be looking at some of these companies, because clearly, while on the one hand, most of so first of all, that's a very wide space, right? So let us look at, for example, the ones which are the favorite right now, which is the quick service companies. Now, those are companies which, because the top line is growing, the market is willing to pay any amount of money. But the reality is that you are looking at a very competitive space, which you have seen some reasonable amount of penetration, but I don't think that the penetration can go beyond a certain level. And more importantly, the cost for delivery in smaller cities will be quite much higher. So you are going to get a lot more competition in the space that you are already in, which is the top few cities of the country. Can it continue to grow? Yes. Has the market priced most of it? I would argue yes. So if you are looking at those kind of companies, maybe it is time to start, at least getting a little cautious about where the valuations can stretch up to. However, there are other places. For example, there are some platform companies which have come through on the travel side, which are doing exceedingly well in the market of late, where I think there may be a little more upside left, only because of the fact that you are looking at a season. Plus, there is a kind of margin lever that you have as the business, for example, moves towards more hotels and less tickets. Some of these companies will do very well. So, companies like Ixigo or TBO Tech and so on, which have the ability to increase their margins, etc., can actually perhaps do a little better, and they are not as expensively priced as some of the others. So it's a question of which theme you're willing to back. I think overall the sector is fairly very expensive, but there will be a few winners, obviously, and the ability to pick out which of those is what's going to determine it, which is a bit of a it's a difficult problem to look at, but broadly, I think you have to be careful about which ones you are going to be backing. Not all of them will do well, and the likelihood is only those which are able to maintain margins is the ones that you should be looking for.
Specific approach is the one Anand is recommended when it comes to the new age tech space. But is there more room for growth when it comes to these new age tech companies? Let's go across and listen into the word coming in from Prakash Khemka, White Oak Capital Management, Professor Sanjay Bakshi, and Manish Sunthalia as well, Director and Chief Investment Officer of MK Investment Managers, and what they're making about the entire new age space and the outlook going ahead.
This space is bound to see a huge explosion of companies and business models over the next 5, 10 years or whatever, 3 years, whatever time frame you see. As a proportion of the index, is bound to multiply from whatever low single digit it is today to first double digit and then potentially 20+% as it is in many of these countries.
So for me, in new age companies that haven't been around for a long time and have not already become very profitable is not something that I would be interested in. That doesn't mean that other investors are wrong when they're investing in it. It's just not my game.
Size of the opportunity is humongous. There is room for everybody. You have many more players apart from Zomato actually enter both the quick commerce space and the food delivery space and the fast food delivery space also, the cafe Zeptos of the world, so to speak. And, even Zomato has come out with a bistro and likewise for Swiggy. And you'll have many more come through in the form of, let's say, JioMart or a Flipkart also announcing the quick commerce model. Size of the opportunity is very big. In retailing, and this be true for any form of retailing, you got to get your unit economics right. And if you get your unit economics right, that is to say per unit order or per unit quick commerce transaction, more than cost of capital, then the sky is the limit for you. And I think, Zomato has the first mover advantage. They have got the unit economics right. They have broken even. They are making contribution margin, which are positive. And now it's only about expansion into tier 1, getting economies of scale.
All right, then moving on, India has actually taken a step further in journey towards developing its first made-in-India aircraft. Sources have told ET Now the Aviation Ministry has sought the Finance Ministry's approval for a special purpose vehicle that will take care of the development needs of this indigenous plane. Also, the project of India's first advanced light aircraft Dhruv will be studied for the key imports. My colleague Sumit is here with all the details. Sumit, over to you.
India has taken a step forward in the making of first made-in-India commuter aircraft. Sources tell us that Aviation Ministry has approached Finance Ministry to approve an SPV, special purpose vehicle, that will be the core of this aircraft. Well, the SPV will be working for 5 years and it will have a mechanism through which they will decide how to take experts from public and private sector and how will they go forward as far as making of this Make in India aircraft is concerned. Well, this aircraft would have a range of up to 700 kilometers. Earlier also, India has made aircraft, not but helicopter, like advanced light helicopter. So some cues will be taken from that also. Well, this project, ALH, was in fact done by India only, and many of these things were indigenously developed. So taking a cue from there, many of these things will be developed as well. This SPV is an important, we can say that, base of forming of this Make in India aircraft, because this SPV will decide how things go forward. There will be experts, finances, everything, but this SPV will be crucial. Later on, the aircraft can be manufactured by a joint venture company, single company, but this step in the direction of forming an SPV and seeking and a finalization from Finance Ministry is an important step in the Make in India aircraft program.
Okay, Sumit, thanks for all of those exclusive details coming by. Aviation is going to be an exciting space to watch out for in the year that's about to come. But on that note, Naresh, I'll come to you for your BTST trades. What's looking good right now?
So continue to be more defensive. First is the buy on Sun Pharma. The stock has, break out and has shown relative strength. The whole pharma pack looks interesting. So Sun Pharma with a stop loss at 1850, target price of 1900. Second is the buy on Container Corporation. The stock has corrected a lot, almost 25% from the top, trying to make a base around that 770, 780 mark. Expecting a bounce back here, stop loss at 780, target price of 800.
Right, so that is the BTST idea coming in from Naresh. Kunal, what are your BTST ideas?
So I'll go with the buy on Paytm. That's a chart which has come back about the 1000 levels. Looks attractive at current zone. Expecting this move, to take the stock back towards 1060 mark over the near term. Stop loss could be kept at 980. And the second would be a buy on Divyan International, something which I flagged off in the morning. The stock is up, 5%, 6% broadly. It's crossed about the levels of 190. Looks fairly attractive. So would revise the targets to 200 and stop loss could be trailed higher to 185.
Okay, so Devyani looking attractive to Kunal, Paytm as well, and for Naresh, it's Sun Pharma as well as Concor. Those are the BTST picks coming in for our viewers. But Naresh, want to come to you, want to get a technical check on Interglobe Aviation. This is a stock that has done pretty well on a year-to-date basis, and aviation is something that has regular news flow, but we've not seen much of a move coming in on this stock recently. How is this stock looking in on the charts, and give us a 6-month sense of what this stock could be like? What are the levels that could Interglobe Aviation could fly to?
So the trend has been strong for the last 1.5 to 2 years. It continued to make higher tops and higher bottoms, topped out at 5,000, saw correction all the way to 3,900, 4,000. But 3,900, 4,000 was the level back in May, June as well. And we made double bottom in October, November. So that's the lower end of the range. On the upper end, it is 5,000. So that could be the next breakout point. In the near term, 4,500 is a support, which is where it broke out from. So any dips closer to 4,500 is a buy, and eventually over the next 6 months, we'll expect it to cross about the 5,000 mark.
Let me come to you and get your view actually on the entire life insurance space, because all of the counters actually saw a very sharp correction on back of regulatory and taxation concerns also around it. What's your take now? Do you think that it merits a relook post the correction now?
Is that for me?
Yes, it's for you.
Yes, absolutely. I think this is a space that, first of all, should be part of a core portfolio. There is no doubt that the regulations have changed and made it a little more competitive because of the fact that many of these companies rely on bank assurance as their major contributors. And, if you have to reduce the share there, especially if you're a parent, it's going to impact them negatively in the near term. But the question is, it impacts everybody. So to that extent, it's not as if it is selective or, there will be some which will benefit a little more than the others, or will be impacted a little more than the others. But across the board, they have to rejig their portfolios a bit and see how they can go back to the areas that they can push through. The client base is still fairly large, though the number of policies sold is now fairly substantial. The value of policies is still fairly weak, and therefore, there is enough scope. So the runway is large. And this is a very sticky kind of business. You get into it once, you cannot get out. So overall, I think it's a great business to be in. And the valuations are not that challenging anymore because of the fall.
Okay, Kunal, also give us a chart check on what some of these names are looking like. SBI Life, HDFC Life, looking good on the charts?
Well, depends on the time frame. I think if someone is looking at this as a very short-term time frame, I don't expect that these stocks would show any kind of a major recovery. For example, SBI Life, HDFC Life have been two stocks which have fallen way below the long-term averages, and the manner in which these stocks had corrected in the last 1.5 odd month, I think that puts a lot of question mark to the near-term trend prospects for these names. The only solace which we have is from the the PSU insurance names likes of GIC, RE, and New India Insurance. I think these are the only two names which have been looking fairly attractive, positive. There's trend momentum as well as volumes chasing into these names. But then the two stocks predominantly SBI Life and HDFC Life, nothing much to write about in terms of the bullish chart patterns for these names.
Right. Naresh, let me come to you and get your view actually coming in on the auto pack. How is this one looking to you, given the fact that we've also seen most of these four-wheeler counters see a downtick on back of the way how they've been reporting their monthly sales numbers. What's your take when you talk about four-wheelers in particular on the charts? Which one is looking attractive to you?
So if you look at the two major names, so Tata Motors has corrected from 1150 all the way down to 700, 750 levels. So it's a large correction already done. The stock had majorly broken out above that 600 mark, which was the high in 2015, 2016. So not much of a downside, even if you were to look at a longer term chart. So out here, it could be a bounce back case. The trend would take much longer to reverse. So a bounce back to 800 would be normal. But overall, the structure is still bad. At the same time, Maruti also, the stock has corrected from 13,000, 13,500 down to the 10,800 to 11,000 mark. If we go back to 2018, the stock had topped out at 10,000. So not a lot of downside. I would not expect it to break 2018 levels. But the structure is still weak. Bounce backs to 11,500 could see selling pressure. It's only about 11,500 we could call it a turnaround.
Okay, Kunal, give me a start check on what IndusInd Bank is looking like on the charts, because we've had news flow coming in today in terms of their auction that they're going to be doing. We have a brokerage note that, although has a buy rating, is also flagging off some major concerns coming in for the bank. The stock is holding up decently okay today, but on a year-to-date basis, it's among the biggest losers, a 40% cut coming in year-to-date. Now, would this stock be attractive after this cut, or do you think that more trouble is still being penciled in for the charts?
So I think over the last 1 month specifically, we've seen the pace of correction for IndusInd Bank to be much sharper. Over the last 3 months, we've seen the stock already correcting from 1500 thereabouts towards 900, 950. I think that was the range or the low the stock had made in the last couple of days. So which means that the stock has shed almost 500 to 600 points in just a matter of the last 3 months. Now the most attractive part which I like about IndusInd Bank as a chart is that the stock is almost at a 30 to 35% divergence from its 200-day moving average. So that itself could be a very good zone where we may expect some sort of mean reversion to play out. But mean reversion is a process which plays out for a span of at least 1 to 3 months, if not more than that. It depends on the beta of the stock and how far or how the stock has fallen, how far the stock is from its long-term moving averages. So price-wise, yes, very attractive. Indicators-wise, very attractive. But whether IndusInd Bank could actually be the leader stock from the private sector banking names, that's the biggest question mark. Because if you expect that the Bank Nifty would recover and IndusInd Bank could be one of the stocks to recover, then I believe that a better alpha could be generated into other private sector banking names, and especially the large cap ones.
Right. Let's talk about the IT sector actually, Mr. Tandon. What's your view coming in the IT sector? No doubt that you have analysts that have also cautioned the fact that the valuations are looking stretched and the runway for the growth seems limited for these counters. But of late, we've seen a lot of interest come back in the IT sector. What's your take? Because there will be a lot of global factors at play this time for the sector.
Well, the sector is a global sector, and the argument that is being currently made in favor of the sector is that, the outlook looks a little better this year than it did last year at the same time. That said, the valuations are such that it is cheaper to buy Google than it is to buy any of the Indian IT companies, and the quality of the business you can make out is significantly worse. So I would think that, from a portfolio perspective, you would have to have some position in IT, especially if this is a sector which will likely outperform, just because it's doing better than last year in a market which is otherwise looking a little strained in terms of finding growth areas. So from that perspective, this could be an area that you may want to hold on to and not be totally out of. But I don't see the major excitement in the sector as such. It is not likely that you will have a major recovery. You will not get double-digit growth coming through, and you are not likely to see, and there will continue to be a sword hanging over the sector in terms of, developments in AI and so on. So net, not something that, you can take a view on in the long term, which is very positive as of now.
Okay, we're wrapping up for today's trading session. Just a couple of minutes left for market close. Kunal, Naresh, a quick outlook on what we can expect Monday's trading session to look like.
So hopefully we see a better momentum getting into the year end and some bit of NAV bump up as well.
Okay, Kunal, do you think 24,000 is possible on Monday? Do you think that's going to happen? Can we watch out for that? Can we be too optimistic when it comes to the Nifty's move on Monday?
Well, it would be slight optimistic. I would not say too optimistic. The only good part about the markets today is that we are now closing in very, very near towards the 200 moving average. For the last 4 consecutive days, if I include today, then maybe 5th, if we close below the average, this would be the 5 consecutive days where we'll be closing just a shade below the 200 moving average. If somehow we manage to come back above the 200 DMA, that's where I would believe that the momentum would come back again for the indices. So as of now, it's very, very difficult to call out because we're just, I think, 20 points or 15 points away from the long-term moving average in terms of closing basis.
Right, so looks like it's not Santa Rally, but looks like it is the Grinch that is at play when you talk about the Indian markets, because we have been sub that 24,000 mark. On that note, thank you so much, Mr. Tandon, Kunal, as well as Naresh for joining us on the show. And as we wind down for the end of the trading session, let's take a look at where the markets are at this point in time, given the fact that you have Nifty that is managing to hold on to the positive territory, but cannot say the same when it comes to the mid-cap index, because that one is under pressure in a trade today. Nifty Bank, for the most part of the trading session, has been moving in tandem with the benchmark indices, and that's exactly exactly how it's going to close in for trading session. 51,350 odd levels is where the Nifty Bank is looking like is going to shut shop for trade today, Snehi. But a lot of stocks were in focus today on back of news flow, with Cochin Shipyard being locked in the upper circuit of about 5%.
Absolutely looking good for Cochin Shipyard. Also looking good for G Shipping. Seems like that positivity in the shipping stocks has slipped over to G Shipping as well, because that's 2%, pardon me, that's Garden Reach that has been doing very well in today's trading session. And let's pull up a Garden Reach and take a look at what that's been up to. Slightly tapered down from the 10% level, but nonetheless 8% uptick coming in on that stock as well. A couple of sectoral movers, then Pharma and Auto have been tussling for that top spot today. Seems like Pharma is going to be the winner going home. Almost 1.5% uptick coming in on Nifty Pharma today. A couple of stocks looking good, like Ajanta Pharma, Glenmark, Laurus, Ipca, Dr. Reddy's, all of them doing pretty well in today's trade. Auto is coming in at number 2, a 1% uptick coming in. M&M, Tata Motors, Aisha, all of them looking good. Escorts has also done pretty well in today's trading session on the back of that note coming in from DAM Capital. Followed by that, FMCG surprisingly has ended the day in the green today. Nifty Bank, Media and IT have ended in the green. What's not done well, and you have a couple of sectors that have tilted towards the red or towards the close. Nifty Metal and PSU banks were already in the red, but joining them now are Nifty Realty and Nifty Energy as well. Nifty Realty led being dragged by Phoenix Limited, a 2% cut coming on that front, and NMDC, Vedanta and Jindal Steel are what are dragging Nifty Metal as well. But overall, that's how we are shutting shop for the day. Quite neck to neck when it comes to the advanced decline ratios, but well, yes, 23,827, so still sub the 23,850 mark on the Nifty. Nonetheless, a 0.3% uptick coming in for both the Nifty and the Sensex. We seem to be ending the day on a positive note, but well, still below that 23,850 mark, so we are going to be slightly disappointed with how the Nifty has moved today, but nonetheless, all's well that ends well, and seems to be a good day for the Nifty share.
Absolutely, and that's the way how the markets have ended for trade today. But with that, we are totally out of time on this edition of Closing Trades. So it's a goodbye from Snehi, myself, and the team that put the show together.